and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm joined today by Morningstar equity analyst Paul Swinand.
Hello, thanks for having me.
Hi Paul. So we're here today to talk about Burberry, which is a stock close to my heart because I have it in my pension portfolio. However, it hasn't performed very well because I bought it at the wrong price. I bought around February last year at its peak of £19 a share. By May this year, it was down to £10.70. What happened?
Well, don't forget, all of luxury has been taking a little bit of a hit. Part of the thing is that luxury in general had strong growth in China and emerging markets. Now that growth has slowed. They're not opening as many stores, and then the same-store sales have been flat to negative as well. Now, I would say Burberry, though, we do rate it a wide moat because it's one of those brands that's been around for over 100 years. We think in the long run, they make a very good returns on capital. The company will not only survive, but eventually prosper again.
And this moat, this is one of the things that we look for when we're looking for a stock that we think will return equity to investors over the long term at Morningstar. And what is the source of Burberry's moat specifically then?
Well, all of the luxury stocks have a strong brand source of moat, and that's because, again, their reputations, their know-how, all the things that they've built to equal what the brand stands for have been built up over literally hundreds of years. So when we think, what is a Burberry trench and why is that different? Why are people willing to pay more for that? Some of it's style, some of it's fashion, some of it might be even that somebody wants a trench that's made in England. But again, it's hard for a competitor to just come one day and say, hey, I've got trenches made in Chicago. They look just like Burberry. You'd still probably pay a premium for Burberry.
And of course, the stock has recovered slightly since May, since that low of £10.70. And what's driven that? Because there has been some news from the company recently, hasn't there?
Well, the interesting thing is when a wide moat stock like LVMH or Burberry or Prada, when they have a low stock price below what we think the fair value is, generally there are a lot of clouds in the horizon that are very visible to investors. Now, the problem here is that because the growth in China has slowed, investors don't really see any good news on the horizon that would take the stock higher again. Another issue has been that Europe has been a tailwind for the luxury industry. As the euro fell a year ago, international tourists rushed in to buy goods at low prices in Europe. The latest thing is, of course, with a cheap pound, tourists have been rushing into London to buy Burberry. Although we kind of think that in the long run, the exchange rate fluctuations will wash out of the real valuation of the stocks. And
there has been some change in the top as well, which always causes you analysts to rethink about any stock. A change in senior management is a time to pause and rethink how we value something.
Well, you know, when we rate a company a wide moat, especially a 100-year-old brand, there are going to be many CEOs over that brand's lifetime. So yes, I think it's a positive change. I don't think they were doing anything so wrong. Sometimes investors get a little anxious or they get a little impatient when they want results to come more quickly. So I don't see that as the reason the stock is up or down. I do think, however, that Burberry is a little more middle priced in the luxury spectrum. I think they're going to benefit from strong middle class growth in China and emerging markets. So in a lot of ways, I like Burberry better than some of the ultra high-end stocks like Hermes that haven't done as poorly because they have very, very high-end customers that haven't slowed down at all. But in the long run, it might be harder for them to outpace the growth of their peers.
So undervalued at this current price, but perhaps it might be a bit of a bumpy road along the way.
Exactly. In other words, it's hard to find stocks that have a clear catalyst coming up without a bumpy road, no risks, no headwinds that are also wide moats and nobody wants to own right now.
Paul, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.